Imagine stepping off a British clipper in August 1842 onto a rocky, wind-swept island. No skyscrapers, no factories, only fishing huts and mangrove swamps. Yet, within 155 years, that barren rock became one of the world's richest cities. How? The answer lies in a unique synergy. British colonial institutions, Chinese entrepreneurship, and shifting global currents that turned Hong Kong from a forgotten outpost into a global financial hub by 1997. The story begins after the First Opium War. Britain needed a secure port for trade with southern China. The Treaty of Nanking, 29 August 1842, ceded Hong Kong Island in perpetuity. In 1841, fewer than 8,000 people lived here, mostly Hakka and tanker fishing families, and infrastructure was virtually non-existent. Colonial governors adopted a positive non-intervention approach. Build only essential roads, docks, and hospitals. Then let merchants and Chinese traders run commerce. From there, Britain would enforce important institutions and policies that would shape Hong Kong today. The first was the introduction of the English common law in 1844. A Supreme Court staffed by judges from London provided contract enforcement that Qing tribunals could not match. Simultaneously, all land became Crown property, auctioned as 75 or 99-year leases. Early auctions sparked fierce bidding for coastal plots, vital for entrepot trade, and generated crucial revenue. With land lease proceeds, British administrators funded strategic infrastructure, Queen's Road extensions in the 1850s, sewage and water systems by 1890, and formal piers. By 1850, harbour traffic reached 2,200 vessels annually, 5 times the 1842 level. Jardine, Matheson and Dent re-exported tea, silk and porcelain to Europe, shipping Lancashire textiles into China. By 1880, entrepot trade hit 32 million Hong Kong dollars, a tenfold increase from mid-century. What truly drove the rise of Hong Kong during this period, however, was a big increase in population. From around 28,000 in 1841, Hong Kong's population grew to 38,000 by 1850 and 78,000 by 1862. Migrants, Cantonese refugees, Hakka labourers, Indian policemen, arrived to capitalise on port activity. Yet living standards remained harsh. Cholera and smallpox epidemics killed thousands. In 1894, a devastating smallpox outbreak in Taipingshan claimed over 10,000 lives, prompting colonial authorities to establish quarantine stations on Ap Lei Chau. Despite shocks, epidemics, piracy, typhoons, Hong Kong's port thrived. By 1910, it handled roughly 1/5 of all Qing exports, valued in the tens of millions of Hong Kong dollars. Local manufacturing remained minimal. Small workshops produced clay pots, rope, and simple goods. Colonial governors resisted intervention in trade and labour, trusting laissez faire to drive growth. Consequently, until World War II, Hong Kong's economy was almost entirely fueled by re-export trade rather than local production. By the mid-20th century, however, the Japanese occupation, 1941 to 1945, devastated Hong Kong. 2/3 of industrial plants lay in ruins. Infrastructure was gutted. In 1946, Sir Mark Young resumed civil administration, backed by the Colonial Development and Welfare Fund, CDWF. The CDWF, allocating 50 million Hong Kong dollars in 1946, repaired power plants, waterworks, and docks. By 1947, trade rebounded to 85% of pre-war levels. Factory registrations jumped 36% from 972 in 1946 to 1,522 in 1974. On top of the Japanese occupation, mainland China was in turmoil. Civil war and communist victory sent nearly 1 million refugees into Hong Kong between 1949 and 1951. British authorities, fearing humanitarian collapse, set up shelters and Union Church refugee centres. But beyond relief, they recognised these newcomers' potential. Many were Shanghai factory owners, carpenters, and small-scale bankers. Hong Kong's population ballooned from 1.5 million in 1945 to 3 million by 1960. Squatter settlements in Kowloon swelled, but these migrants also provided a cheap, eager labor force. Factory wages averaged $1.80 per day in 1965. Then there was the embargoes made by the US and the UN on non-strategic goods to the PRC, 1950 to 1953, which severed Hong Kong's re-export trade with mainland China. To avert collapse, British-led authorities, though reluctant, introduced pragmatic measures: tax exemptions on imported machinery, modest utility subsidies, and tariff waivers on raw materials needed for export-oriented industries. Chinese entrepreneurs converted sewing machines and plastic molding presses into light manufacturing: textiles, watches, toys, and plastics. Between 1947 and 1960, textile exports soared from 57 million Hong Kong dollars to 2.8 billion Hong Kong dollars, representing 35% of total exports. By 1966, 40% of the labor force worked in manufacturing, and locally made goods comprised 80% of exports. Profits from these industries fueled new investment in factories and real estate. Public housing initiatives, starting after the 1953 Shek Kip Mei fire left 58,000 homeless, transformed shanties into high-rise estates. Land lease revenue, HK totaled 250 million in 1955, financed roads, schools, and waterworks, reinforcing a basic infrastructure network without overburdening colonial coffers. Exploiting land lease income, British-backed agencies built crucial infrastructure. The Housing Authority, restructured in 1973 with British civil service input, completed over 100,000 units by 1961, following designs imported from Britain's council flat models. In 1967, Governor Sir David Trench approved electrification of the Kowloon Canton Railway, completed in 1983, slashing travel time to Guangzhou and boosting cross-border commerce. In 1972, the British-funded Kwai Chung Container Terminal opened, halving turnaround times compared to Singapore, and by 1980 it handled over 6 million TEUs, ranking among the world's busiest ports. The Mass Transit Railway launched its first line in 1979, designed and built with British civil engineering expertise, relieving chronic traffic congestion and facilitating the daily commute of thousands. By 1969, per capita GDP jumped from $436 in 1961 to over $825. Factory wages supported modest middle-class lifestyles: transistor radios, restaurant meals, occasional cinema, fueling a visible middle class that invested in British-run schools like Diocesan Boys' School and the Government Technical Institute. However, inequality widened. The Gini coefficient rose from 0.38 in 1960 to 0.45 by 1970. British laissez-faire policies kept unions weak, and employers offered minimal protections. Housing demand outstripped supply, rendering real estate unaffordable for many working families. By the early 1970s, Hong Kong's manufacturing sector employed nearly 40% of workers, but rising wages, US $1.80 per day in 1965 to over US $4 by 1975, and competition from South Korea, Taiwan, and Singapore squeezed margins. Entrepreneurs sought higher value manufacturing and services. Recognizing these pressures, colonial authorities, backed by London, shifted focus. In 1978, Governor Sir Murray MacLehose persuaded the British Treasury to lift a moratorium on new banking licenses. By 1984, licensed banks increased from 54 in 1970 to 176. Simultaneously, in 1983, British and local officials pegged the Hong Kong dollar to the US dollar at 7.80 Hong Kong dollars. This linked exchange rate, endorsed by British macroeconomic advisors, provided the currency stability that attracted foreign capital. The peg withstood Black Monday and the 1997 Asian financial crisis, thanks to reserves built under British stewardship. Deng Xiaoping's reform and opening policy transformed Hong Kong's role. Though still a British colony, it served as China's gateway. In 1979, London discreetly allowed Hong Kong firms to establish satellite factories in the newly designated Shenzhen Special Economic Zone. British-run agencies, notably the Hong Kong Trade Development Council, organised trade delegations to Shenzhen, advising Hong Kong entrepreneurs on setting up operations and exporting machinery. By 1984, over 100 Hong Kong-registered enterprises operated in Shenzhen. By 1990, that figure soared to 1,200, employing hundreds of thousands of Guangdong workers. These satellite factories, financed, managed, and marketed from Hong Kong, captured design, marketing, and logistics roles at home while leveraging cheaper mainland labour. British advisors from London's Department of Trade and Industry drafted export license protocols to expedite machinery shipments, ensuring a seamless Hong Kong-China supply chain. By 1984, services accounted for over 80% of GDP, even though manufacturing output continued to grow in absolute terms. British-run departments, the Trade Department and the office that became the Hong Kong Monetary Authority, streamlined licenses for insurance, shipping, and business services firms. The Legal Aid Department, staffed largely by British-trained solicitors, ensured transparent judicial processes, further attracting multinationals. The Hong Kong Stock Exchange experienced its first sustained bull run in the early 1970s, leading to a tenfold increase in market capitalization between 1970 and 1980. British advisors recommended forming a listing committee in 1978, clarifying rules and speeding approvals. By 1984, market capitalization surpassed 200 billion Hong Kong dollars, drawing global funds. Then, British-led reforms, bank liberalization, integration with China, infrastructure expansion, and continued laissez faire policies had transformed Hong Kong from a manufacturing hub into a predominantly service-oriented, globally connected economy. But all of these would change during the Sino-British negotiations. If you were an investor in 1982, you'd ask, what happens when the 99-year lease on the new territories expires in 1997? Britain owned Hong Kong Island and Kowloon in perpetuity, but the new territories, 86% of the colony's land, were leased until 1997. If China refused to renew, Hong Kong would be halved. London dispatched Prime Minister Margaret Thatcher to Beijing in September 1982, her first visit since 1950. Over 2 years, British negotiators, led by Sir Geoffrey Howe and Governor Sir Edward Yaoud, pressed to retain full sovereignty. Beijing insisted on reunifying all ceded territories. On 19 December 1984, the Sino-British Joint Declaration was signed. Britain would return the entire colony on 1 July 1997, but China promised to preserve Hong Kong's capitalist system, independent judiciary, and way of life for 50 years under one country, two systems. British negotiators secured basic law provisions that enshrined English common law, protected private property, and safeguarded capital markets. London's Foreign and Commonwealth Office lawyers vetted draft articles to ensure consistency with the Joint Declaration. Guarantees covered no new taxes, continued operation of the Independent Commission Against Corruption, and preservation of Canton Road land lease revenue allocations. Despite looming sovereignty changes, Hong Kong's economy boomed. Real GDP grew 5.7% annually from 1984 to 1990. The Securities and Futures Commission, formed in 1986 under British-inspired regulations, improved market transparency. Licensed banks reached 210 by 1990 as global banks sought to position themselves in Hong Kong's stable environment. The property sector surged. Office vacancies in Central fell under 2% by 1988. Prime rents doubled between 1984 and 1988. Though British memos warned of an impending bubble as early as 1986, speculative fervour persisted, driven by rising incomes and capital inflows. On 19 October 1987, global markets crashed. Hong Kong's Hang Seng fell 45% over 2 days. The HKMA, rooted in British policy, intervened, purchasing equities and defending the Hong Kong dollar 7.80 peg. By mid-1988, the Hang Seng had recovered to 20% above its pre-crash high. This resilience underscored colonial institutions' strength. A small economy weathered a massive shock without systemic collapse. Despite robust growth, political reform was cautious. Under Governor Chris Patten, directly elected legislative council seats increased to 20 out of 60 in 1995. Beijing condemned these reforms as breaching the Joint Declaration, heightening tensions. Between 1984 and 1988, over 200,000 residents applied to emigrate, fearing post-1997 erosion of freedoms. By 1990, Hong Kong was a mature economy. Services accounted for 80% of GDP, manufacturing contributed 20%, and British-stitched legal, financial, and civil service frameworks continued to attract global capital. Yet beneath the gloss, widening inequality, environmental stress, and political uncertainty foreshadowed challenges ahead. As the 1990s began, Hong Kong surged into a final, euphoric boom. Despite sovereignty uncertainty, GDP grew about 6% annually from 1990 to 1997. In 1993, Governor Chris Patten, appointed by Prime Minister John Major, deepened reforms. The Securities and Futures Commission launched under British-modelled regulations, tightening broker oversight. By late 1993, Patten introduced a limited stamp duty on second home purchases in 1994, Hong Kong's first significant property tax, to damp speculation. Though transactions fell 8% in early 1995, rising equity wealth drew speculators back by 1996. Between 1990 and 1997, property prices rose 150%. Prime office rents in Central hit 400 Hong Kong dollars per square foot per month by mid-1997. Developers, buoyed by low interest rates, Hong Kong Monetary Authority base rates near 6%, financed skyscrapers like IFC Tower 1 and Pacific Place. Despite British warnings of overheating, laissez faire prevailed. By the mid-1990s, Hong Kong was China's principal offshore finance center. In 1994, British and Chinese authorities launched an offshore renminbi bond program, allowing PRC entities to issue RMB-denominated bonds in Hong Kong under British-regulated clearing systems. By 1996, offshore RMB deposits surpassed $2 billion, cementing Hong Kong's role as mainland China's key offshore RMB hub. Despite record growth, social strains mounted. By 1996, the Gini coefficient reached 0.53, among the highest in developed economies. The bottom 20% of households saw real incomes rise only 10% from 1980 to 1996, while the top 10% tripled theirs. Despite incremental reforms, political representation remained limited. In 1995, only 20 of 60 LegCo seats were directly elected. The remainder were appointed or elected via functional constituencies. Beijing denounced Patten's reforms as unilateral violations of the Joint Declaration, heightening tensions. Consequently, from 1994 to 1997, over 150,000 residents obtained British national overseas passports, while another 100,000 sought emigration to Canada or Australia. This brain drain threatened to deprive Hong Kong of the talent needed to sustain a knowledge-based economy post-1997. By late 1996, per capita GDP peaked at $24,800, surpassing the UK, $24,400, and dwarfing South Korea, $13,400. Annual visitor arrivals exceeded 10 million. Port throughput reached 14 million TEUs. Yet, as 1 July 1997 approached, lingering unease lingered. Would Beijing honor one country, two systems? At midnight on June 30, 1997, Britain lowered the Union Jack. On July 1st, China raised its five-star flag. The Basic Law took effect, and the Hong Kong Special Administrative Region government assumed power. Within weeks, the Asian financial crisis erupted. Speculators attacked Thailand's baht in July 1997, followed by the Malaysian ringgit and Indonesian rupiah. On 5 August 1997, Thailand floated the baht. triggering a regional panic. Hong Kong, now under Chinese sovereignty, yet still operating British-designed systems, mobilized a robust defense. Citing the Basic Law's monetary safeguards, the HKMA, rooted in British-era policy, spent $15 billion from the exchange fund to buy Hong Kong stocks and defend the Hong Kong dollar 7.80 peg. Although property values plunged 40% by 1999, the peg remained intact, validating decades of British monetary stewardship. The crisis deepened social strains inherited from colonial policies. Unemployment rose to 5% in 1998. Many middle-class families saw portfolios lose half their value. In London, former colonial secretaries Lord Young and Lord Home publicly urged the HKSR government to expand social safety nets, warning that British interests and reputations hinged on a stable transition. Consequently, the Property Market Support Scheme was extended to help small homeowners refinance mortgages, modelled on British council housing loans. While Britain's role is credited with Hong Kong's success, preserving rule of law, establishing a free port, and building infrastructure, this narrative must be balanced against valid criticisms. The first issue that Hong Kong faces from Britain's role can be attributed to socio-economic inequality and housing stress. By 1996, Hong Kong's Gini coefficient hit 0.53, among the highest in developed economies. Colonial policies, minimal redistribution, and reliance on land lease revenues concentrated wealth. By 1997, average apartment prices topped 10,000 Hong Kong dollars per square foot, rendering home ownership unattainable for many wage earners. Although public housing units exceeded 600,000 by 1997, waiting lists still numbered over 200,000 families. Critics argue British fiscal restraint limited social investment. By the mid-1990s, property and financial services comprised over 60% of GDP. Analysts cautioned Hong Kong risked becoming a paper economy, reliant on speculative bubbles rather than diversified production. When the Asian financial crisis struck, property values fell 40%, bankrupting small investors and contracting domestic consumption. The banking sector encountered liquidity crises, only alleviated by HKMA emergency loans, an apparatus built under British oversight but used by post-handover authorities. Many key infrastructures, MTR tunnels, container ports, office skyscrapers, were funded, designed or initiated under British rule. Yet this colonial legacy induced complacency. By 2017, Hong Kong's population exceeded 7 million. Straining transport and utilities devised for 3 million. Critics argue British planners, focused on immediate economic returns, failed to anticipate this explosive growth or long-term sustainability needs. British contributions, however, while sometimes controversial, must also be credited. The biggest contributions they brought was the enforcement of contracts, and Privy Council appeals remained available until December 1997, fostering investor confidence. Secondly, London eliminated tariffs and refused to impose sales or income taxes. Corporate tax stayed at 15% through the 1970s. Stamp duties on property were minimal until 1980. By treating all land as Crown property auctioned under long leases, colonial administrators secured a reliable, high-margin revenue stream. In 1975, land lease revenue comprised 35% of government income. Beyond institutions, they have investment into infrastructures and established macroeconomic stewardship. Under Governors Bowring, John Pope Hennessy, and MacLehose, British administrators deepened Victoria Harbour, expanded piers, and opened container terminals at Kwai Chung and Tsing Yi. These, and so much more, are still seen in Hong Kong today. Yet these British foundations required Chinese entrepreneurial vigour. Shanghai textile magnates in 1949, Cantonese merchants in the 1970s, family conglomerates, Li Ka-shing's Chung Kong, Kwok Tak-seng's Sun Hung Kai, leveraged colonial frameworks to build sprawling empires. Without this synergy, colonial policy alone could not have produced decades of compounding growth.